Hello, everyone. I'm Yali Jing. Macquarie just revised their precious metals outlook for 2026, and the numbers they're putting forward for silver aren't just optimistic. They represent a fundamental reassessment of where this market is heading. We're not talking about minor tweaks. We're talking about price targets that reflect structural changes in supply, demand, and the broader role silver plays in the global economy. And if they're right, most investors are still positioned for the market that existed 2 years ago, not the one that's taking shape right now. Before we go further, subscribe right now, because what you're about to hear explains a shift most investors still haven't noticed. Let me walk you through what Macquarie actually said, and more importantly, what the data behind their revision tells us. Macquarie raised their average silver price forecast for 2026. They're now expecting silver to average around $28 to $30 per ounce, with potential spikes higher depending on how certain catalysts play out. For gold, they've also increased their outlook, projecting an average near $2,900. But it's the silver revision that matters most here, because it signals something larger than just a commodity in a bull cycle. It signals recognition that silver's supply-demand fundamentals are tightening in ways that can't be easily resolved. Now notice what changed. 6 months ago, most major banks were forecasting silver to remain range-bound between $22 and $26. The assumptions were straightforward. Industrial demand would grow modestly, investment demand would stay muted, and mine supply would gradually increase to meet that demand. But those assumptions have broken down. Industrial demand hasn't just grown modestly, it's accelerated. Photovoltaic solar panel production alone consumed over 200 million ounces of silver in 2024, and that number is expected to climb above 220 million ounces this year. That's nearly 20% of total global silver supply going into a single application. And that application is expanding at double-digit rates annually. Look closely at this trend. Electric vehicles, 5G infrastructure, semiconductors, medical devices, every major technology sector experiencing growth right now is also silver intensive. The average electric vehicle uses between 25 and 50 grams of silver. As EV adoption scales from 3 million units annually to 10 million, 15 million, or 20 million units over the next several years, that demand doesn't just add up, it compounds. And unlike gold, which is primarily a monetary and jewelry metal, silver faces this dual demand profile. It's both an industrial metal and a monetary hedge. That creates a tug-of-war that gold doesn't experience. But here's where it becomes important. Supply isn't keeping pace. Global silver mine production has been essentially flat since 2016. We're talking about roughly 850 to 900 million ounces per year with minimal growth. New mine development takes years, requires significant capital, and faces permitting challenges that have only intensified. Most silver is produced as a byproduct of base metal mining, copper, lead, zinc. So when copper mines slow down or face operational issues, silver output drops as a secondary consequence. Miners can't just turn on more silver production in response to higher prices the way they might with a primary metal. Now combine that with what's happening on the investment side. Silver ETF holdings declined sharply in 2022 and 2023 as investors rotated out of commodities and into equities during the Fed's tightening cycle. But that trend has reversed. We've seen consistent inflows into silver-backed ETFs since late 2024, and physical silver bullion demand from retail investors has surged. Mints around the world, US Mint, Perth Mint, Royal Canadian Mint, have reported delays in rationing of Silver Eagle and Maple Leaf coins due to overwhelming demand. That's not speculative positioning. That's real physical metal being pulled out of the available supply pool, locked into long-term holding patterns. This pattern has appeared before. In 2010 and 2011, silver rallied from $18 to nearly $50 in a matter of months. The drivers were similar. Concerns about currency debasement, rising industrial demand, and a supply base that couldn't respond quickly. The rally overshot and corrected sharply, but the underlying thesis wasn't wrong. It was just early. The difference now is that industrial demand is structurally higher, not cyclical. Solar installations aren't a trade. EV adoption isn't a speculative bet. These are multi-decade infrastructure shifts that require silver at scale. Let me show you another dimension. The gold-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, has been trading in a wide range between 75 and 90 over the past 2 years. Historically, that ratio averaged closer to 60. When it compresses toward that historical mean, it implies either gold falls, silver rises, or both move, but silver outperforms. If gold holds near $2,900 and the ratio moves back toward 60, that puts silver north of $48 per ounce. Macquarie's forecast of $28 to $30 isn't calling for that kind of reversion. It's calling for a modest move higher with volatility. But if investment demand accelerates, or if a supply disruption occurs, the upside scenario becomes much larger. Now notice what central banks are doing. Gold purchases by central banks hit record levels in 2022 and 2023 and remained elevated in 2024. That's a signal about confidence in fiat currencies and concerns about long-term inflation and geopolitical risk. Silver doesn't play the same role in central bank reserves, but it benefits indirectly. When gold rises on monetary concerns, silver follows because investors view it as the more accessible monetary hedge. It's the poor man's gold, but that label undersells its utility. Silver has industrial applications gold doesn't have, and it's far more affordable for smaller investors building positions incrementally. Look at what's happening with interest rates. The Federal Reserve has paused its tightening cycle, and market expectations now price in potential rate cuts later in 2026 if inflation continues moderating or if growth weakens. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver. They also tend to weaken the dollar, and silver, like gold, is priced in dollars. A weaker dollar makes silver cheaper for foreign buyers, which stimulates demand and supports prices. Macquarie's forecast likely incorporates a scenario where rates remain elevated but not rising, and where the dollar stabilizes rather than strengthens aggressively. If the dollar weakens more than expected, their forecast could prove conservative. But here's where it becomes critical. Even without a dollar collapse or a monetary crisis, the supply-demand fundamentals for silver are tightening in ways that create upside risk to any forecast. The Silver Institute estimates that the global silver market ran a deficit of over 200 million ounces in 2024. That deficit was filled by drawing down inventories, recycling, and investor selling. But inventories aren't infinite. Above-ground stocks held in ETFs, vaults, and accessible forms have declined. Recycling can increase, but it's limited by the available scrap supply and the economics of collection and processing. And investor selling reverses when sentiment shifts, which it appears to be doing now. What this suggests about inflation is significant. Silver has historically acted as an inflation hedge, though not as consistently as gold. When inflation expectations rise, investors often rotate into tangible assets. Silver benefits from that rotation, particularly when inflationary pressures are driven by supply-side constraints and fiscal expansion rather than just demand-side overheating. The industrial demand for silver also correlates with economic activity, which creates a paradox. Silver can rise in both inflationary and growth-driven scenarios. That dual sensitivity makes it attractive in an uncertain macro environment. What this suggests about currency confidence is equally important. The explosion in sovereign debt globally, US, Europe, Japan, China, has raised questions about the long-term stability of fiat currencies. Gold has been the primary beneficiary of that concern, but silver participates. Investors view precious metals as a hedge against the debasement of purchasing power that comes from prolonged fiscal deficits and monetary expansion. The fact that central banks are buying gold at record levels while also expressing concern about inflation sustainability tells you confidence in paper currencies is fragile. Silver, as a more volatile and accessible alternative, captures some of that hedging demand. What this suggests about investment psychology is revealing. For years, silver was dismissed by institutional investors as too small, too volatile, too industrial to be a serious portfolio allocation. But that perception is shifting. As ESG mandates push capital toward green energy infrastructure, and as that infrastructure requires massive amounts of silver, institutional investors are reconsidering their exposure. Silver isn't just a speculative play anymore. It's an input to the energy transition. That reframing changes how it's valued, and it changes who buys it. So where does that leave us? Macquarie's updated forecast reflects a market that's tighter, more complex, and more sensitive to disruptions than it was even a year ago. Their target of $28 to $30 for 2026 isn't a moonshot. It's a measured assessment based on elevated industrial demand, constrained supply, moderating interest rates, and improving investment sentiment. But the risks are skewed to the upside. If solar demand exceeds expectations, if a major mine faces operational issues, if geopolitical tensions disrupt trade flows, or if inflation proves stickier than anticipated, silver could move significantly higher than that range. The long-term implications for investors are clear. Silver is transitioning from a niche speculative metal to a critical industrial commodity with monetary characteristics. That transition creates opportunity, but it also creates volatility. Investors who understand the supply-demand dynamics, who recognize the structural drivers behind industrial demand, and who are prepared to manage the volatility will be positioned to benefit. Those who ignore the fundamentals and chase price momentum will likely get caught in the swings. Thanks for watching. Subscribe, share this, and stay alert.